Hi, this is Ken Crotty, and I want to say thank you to everybody who's attending our part two of our charitable planning presentation, which is being given by Michael Lehmann. As I mentioned the first time, Michael is a recognized national expert, and if we have a question that we are not confident on with respect to anything charitable related, he is our go-to guy. So I encourage you to enjoy the presentation today. Hopefully you'll learn a lot, but remember Michael's name and his contact information, because going forward, if you need anything, we definitely recommend contacting him. He's done great work for us and for our clients. So with that, Michael, I'll hand it off to you.
All right. Thank you very much, Ken. Just a welcome, everybody, and a quick refresher on what our objectives are. Today, we're going to wrap up some particular discussions on certain non-cash assets, and then get to the very, very important topic of proper substantiation for non-cash items. I have a couple of case studies at the very end. Not sure we'll get there, but these are sanitized versions of actual cases that I've dealt with. So let's kick off here with real estate, which is one of the most popular forms of non-cash charitable contributions after stock. And there's a lot of different types of real estate. There's a lot of different ways to donate real estate, and there's a lot of tax and some important non-tax issues in dealing with gifts of real estate. I'll try to touch on the highlights of each of these things. Most straightforward thing is just to make a gift, just a deed over, if you're dealing with a form of real estate that's readily deedable, which is most, like vacant land and sometimes industrial property, commercial property, residential property, apartment buildings, timeshares, which are often proposed for donations. I try to talk charities out of it. But people like to give them. There may be a little extra complexity. Interest in oil and gas and minerals, I lump into the real estate category as well. Though some of those assets are not represented by deeds that are so readily transferable, but often it's just a question of signing the deed over to the charity, getting the deed recorded. Typically, even in jurisdictions like New York City that impose a ridiculous panoply of transfer and deed recording taxes, there are exemptions for donative transactions involving charity. So it can be a fairly easy thing to do mechanically. If you're dealing with a public charity, which is what the top note says, well, you're going to, just like we talked about last week with the general topic of non-cash contributions, you should get a deduction for the fair market value of the property. If you're dealing with a contribution to a private foundation, actually I short the second bullet there is a little short. It's actually what you get is the lower of basis or fair market value, which tends to be basis in the transactions I deal with, because it's usually real estate is usually appreciated rather than depreciated. But that's the actual statement of the rule. Now, this is all very, very easy and straightforward if you're dealing with unencumbered, as the top bullet says. Unencumbered, no mortgages or other indebtedness or liens or anything like that. Straightforward transaction, tax-wise, pretty straightforward transaction. On the donee side, I don't have slides on this because these are really non-tax points, but and I represent parties on both sides of the table in these transactions. Real estate, some types of real estate are reasonably liquid, or a charity is happy to hold them for production of income. I almost invariably recommend a charity not take title directly, but form either a nonprofit holding company, sometimes just a single member LLC, to keep itself out of the direct chain of title. That can be particularly important if you're dealing with any potential for environmental hazards or other environmental issues. If you're anywhere near a Brownsfield or a Superfund site, sometimes they'll even recommend multiple layers between the charity and the property, just to keep the actual operating charity a little bit removed from those risks. Taking on a donation of or accepting, I guess I should say, the donation of real estate. From the charity's perspective, well, this is not an inexpensive asset to hold. Stock is an inexpensive asset to hold. Business interest, LLC, LP interest, like we talked about last week, those are typically inexpensive assets to hold. There are sometimes funny wrinkles associated with flow-through entities, like there might be capital calls, and you have to worry about whether the donee is actually going to be on the hook for capital calls. But with real estate, there's costs of operations and maintaining real property. Depending upon what the charity is going to do with the real property, there may or may not be real estate taxes on it. Real estate taxes can be a bear. In the LLC structure, which I use a lot in New York City, the real property tax people respect that most single-member LLCs are disregarded for tax purposes, and they will disregard them for New York City real property taxes. That is a super minority position. I'm constantly encountering taxing authorities outside of New York City that will not look through a disregarded LLC. They regard it. There was a case in New Jersey fairly recently on a single-member LLC where the charity lost that basically on the basis that LLCs are not organized for the typical list of purposes that you see in the statute. Some states you can actually write an LLC agreement for nonprofit purposes, and some states you can't. So those are all the sort of non-tax side issues with a gift of real estate, unencumbered or not. When you get down to real estate that's got a mortgage on it, these things get a lot of hair on them. Again, thinking mostly on the donation to the public charity side, the presence of a mortgage and how the mortgage is handled in the transaction, whether the donor holds on to it, whether the donor is released from it and the charity assumes it, that can give rise to a whole level of additional tax consequences just beyond getting a deduction for the real estate. And of course, the presence of the mortgage and how the mortgage is being handled can also have an impact on the valuation of the real estate. While looking at that second bullet point on this page, while typically rents from real estate are not unrelated business taxable income. So if you're back up in the top scenario and looking at a gift of unencumbered real estate, the charity holds it, decides just to collect the rents, that's tax-free income. Now, of course, there's expenses, but there's tax-free income associated with that. Debt finance property, which is what it's a fancy term in the code, but basically property in which there's a mortgage. Well, that will generally result in the charity's income from the property, if it holds it, being unrelated business taxable income. Again, in calculating the taxable income, the charity will get to take deductions for expenses, but it's still going to be now filing an additional return, a 990-T, if it isn't already. So these transactions, actually, in my experience, are pretty rare. While I deal with a lot of gifts of unencumbered real estate of every type and description, I can't remember more than a couple of transactions where there was a mortgage on the property. Generally, one can't get a charitable contribution deduction for a gift of a partial interest in an asset. You got to give the whole enchilada. But there are some funny special rules that permit some partial interest in real estate to be contributed. The one that is probably most commonly encountered is a retained life estate and a personal residence. There's also a rule for certain farm property where you can donate partial interest. Never actually dealt with that. Dealt with a lot of partial interests, retained life estates, and real estate. When you're giving a partial interest, now you're essentially go back to the old law school bundle of sticks analogy for property rights. You've got a bundle, the donor's got some sticks, and the charity's got some sticks. And in transactions like this, where particularly if a charity thinks it might hold it for a while, but it might really want to sell it, the occasions when I've had to encounter this, I've almost always encountered difficulties in finding someone to take the property and create liquidity for the charity. So while these things can be interesting for certain donors who really want to, hang on to the personal residence and give the remainder interest, they're actually fairly tricky to implement. I can't touch upon the topic of real estate without the topic of conservation easements, which, if you follow things like the daily tax report and tax notes, you probably are seeing now, probably every week or so, stories on the IRS's full-scale assault on particular type of syndicated conservation easement transactions, which are just being blown to smithereens. The conservation easement transactions that I've dealt with, none of them have been syndicated or fallen into the types that the IRS hates, which they're actually listed transactions too, which is a particularly nasty designation to get. But they're out there in appropriate circumstances. These are pretty interesting transactions where basically an owner of property puts an easement on it to protect some of the property for conservation values. And so that essentially reduces the value of the land because now it's not, apartment buildings and such aren't going to go on it. I've had many clients with real estate holdings grant conservation easements. None of them have attracted IRS audit attention. There's, as in everything, there's a little hair on some of these too. I've had colleagues, not myself, have audits where the IRS has actually claimed, and once or twice successfully, that the addition of the conservation easement actually increased the value of the property by preserving beautiful views forever and taking away the risk that a shopping mall was going to show up and mar the scenic beauty, which is an interesting, when I've talked to them about these cases, interesting argument. The theory is that by restricting usage of the land, you're generally reducing its value, but not necessarily. Art, antiques, and collectibles. The big issue here is the related use rule. So you get to deduct the fair market value of the object, assuming we're dealing with art, antiques, etc., held as capital gain property. But since this law came into the code a few years back, the good old days of people sitting on giant art collections and just donating them to all sorts of charities and taking their full deductions, those are gone. There's some wiggle room. You don't always have to be dealing with a museum of art, although those are the most common transactions. The art can be made use of in some other settings. I've seen art donated to hospitals, educational institutions, and some others and have tried to work through, navigate this related use rule. But it is a pretty big break on just, you're sitting on the antique clock and things like that. Big appreciation value. Give it to anyone and get a charitable contribution deduction. So if you're in this field, that's the thing to remember, along with appraisal and substantiation, which are coming up, the related use. So here, these are some of the scenarios I've dealt with. Art being donated to museums, art being donated to universities, and then, not just to a university in general, but where, if the art is going to be used in this part of the university, is that a stronger related use case than it's going somewhere else? And that kind of level of nuance actually becomes pretty important with the related use. A fairly popular giving technique, which again received some cutback not long ago, was the donation of fractional interest in art. interest in paintings. Donors would contribute partial interest in works of art. The museum could display it some part of the year. The donor could hold on to it. That used to be a bonanza. It's considerably cut back. It's still a feasible giving technique, particularly with art and museums. If you're contemplating doing it yourself, working with a client on this, it can be navigated, but it's hard. But this is a second really important rule with arts and antiques. Gemstones. I mentioned the gemstones here because, well, you can donate gems. You can donate rocks and minerals. Again, no asset is really outside the scope of what can be donated. But back in the early 1980s, there was this fascinating. I was just before I started out, fascinating story about how, and there's a link, and most of the articles from the Washington Post are still up. They were illustrating kind of how non-cash contributions can sometimes be a little bit on the abusive side. But I have had clients legitimately donate gemstones, minerals, rocks, etc. Interesting story here from the New Yorker, and you can pull it up on a transaction that apparently didn't come to pass, but it was a big conservation easement transaction. The New Yorker article is very, very long, but it's fascinating. And if this topic is of interest, I recommend you track it down. That's the full site to when the article first appeared. Probably the last asset we'll spend any real time on today, because I want to get on to appraisals and substantiation, is life insurance. Life insurance, very, very popular device for giving to charity. There's actually several other ways. There's probably at least three fundamental ways, and here I'm talking about donating a policy, which is a very common way to do it. But there's other ways to get value of life insurance into charity. Certainly policy transfers, so that the charity becomes the owner with the ability to name itself or not as the beneficiary, is a major one. People also will sometimes get policies and name charities as beneficiaries. That's not strictly in our topic here today, because it's not really donating a non-cash charitable asset, but that is another way to work with essentially non-cash assets and charitable giving. And a third way that is used with life insurance is actually charity making gifts to a charity of premium costs for the charity to take out a policy on the life of the donor, or in some cases maybe a family or a pool of donors. There is some non-tax hair in transactions like that. Some states have passed specific laws. Pennsylvania has a very good one that specifically declare that a charity has an interest in the life of the donor, and this is sort of an insurance law topic. The idea is that life insurance policies, when someone takes one out and somebody else, is supposed to be what is called an insurable interest. And in most of the circumstances where people buy policies for their families, or if they're in small businesses to provide liquidity for the business if something happens to them. But in other variants of life insurance, sometimes they're called corporate-owned life insurance. Some years back, there was this thing derisively called the janitor life insurance. That came and went. But charitable-owned life insurance is still exists, and still an interesting technique for doing charitable giving with life insurance. So now, for our remaining 10 minutes, which is about right, two critical topics in non-cash charitable giving. And I have on some subsequent slides a couple of the horror stories, which are, if you are dealing with charitable contributions of property, you have to know about these cases. You should read them. for their bracing effect on your making sure everybody's paying careful attention to dotting all the I's and crossing all the T's. So there are special appraisal rules for most gifts of non-cash property, depending upon the value claimed for the non-cash property. And that's kind of on the donor side to get those and make sure that all those rules are followed. And then, equally important, there are the substantiation rules, the rule where what most of us are familiar with is you write the check, I think it's for $250 or more, you need to get a substantiation from the charity. Well, these substantiation rules, they apply to non-cash donations as well. I'll go through a couple of those cases a few pages down. But the critical thing to remember is that failure to comply with either getting a proper qualified appraisal or getting a proper gift substantiation can blow donations, as you'll see in these slides. One of the biggest to date was $64 million charitable contribution. There's tons of cases on 19, 20, $30 million donations. The mind reels when you read these cases, especially when you see how absolutely mercilessly and rigidly courts have adhered to the requirements. So, I probably lose 5 pounds in sweat every time getting ready to close one of these transactions because of the possibilities of tiny footfalls, as you'll see. If we get to them, or if you should, if we run out of time, you should look at these cases. What appear to be tiny footfalls result in absolute fiascos. On the qualified appraisal side, those are pretty easy. There is one thing that I want to particularly note, but the IRS has published plenty of guidance as to things that have to be in an appraisal to make it a qualified appraisal. You would think they'd be pretty easy to do. There are things like, what is the appraiser's background, a statement that simply says the appraisal is being done for federal tax purposes, a description of the fee arrangement, a few other things. I have had people in the appraisal business who have claimed to have given, thousands of appraisals, have been expert witnesses in tax court cases, etc., fight me on some of the elements of a qualified appraisal. My favorite one was one of the elements that's on the IRS list. These are easy. There's a rev proc. It says this is a qualified appraisal. It's easy to read and easy to follow. Wouldn't give his taxpayer ID number, which is right there on the list. I don't know how many hours I spent back and forth with marking up this appraisal, and eventually we got it because, I won't go into that, but we got it. But he fought it, and I've had other appraisers fight, including there are certain statements that the appraisal is supposed to have. The way the cases have come down on absolutely merciless strictness in the reading of the requirements, I will settle for nothing that does not, in my judgment, absolutely 100% conform to the qualified appraisal rules. And here we have a qualified appraisal failure. This was a $19 million donation. Case is absolutely worth reading, Muhammad versus Commissioner. It's not that old. You read these cases and the court clucks in sympathy. Oh, yes, it sure was a good charity and it sure was put to good charitable uses and blah, 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 blah. But looky here, look who signed this appraisal. It was the taxpayer. Well, who was in the real estate business, the real estate broker, but failed to be a qualified appraiser as defined. And again, it's easy to check this stuff because he was also the donor, and the donor can't do his own appraisal. That should seem almost obvious to people. I don't know why it wasn't obvious in this case, but and down the whole thing went. And the court in that case said, these requirements are construed strictly. Both the qualified appraisal and the substantiation letter or documentation requirements are construed at the strictest things I've ever seen in tax law. There's a doctrine of, in certain regulations, substantial compliance, and sometimes in totally other areas of the law. Sometimes if a taxpayer hasn't followed every tiny detail but substantially complied, there are cases in those other areas that say it's all right, you're good, most of it's there. with the appraisals and the substantiation, nothing, zero, no room for error. So here's another. Look at this. You see the second bullet. If you're in this area, you've got to read these cases because you see these things. And there was you have to do a Form 8283 as a report of non-cash charitable contributions. It's not a very complicated form, but this one thing was missing. And the court said, everything on that form is absolutely vital to the regime. You miss one little thing and you're dead. And I commonly see draft 8283s that are deficient in one area or another, and have to fight tooth and nail to make sure the final document is absolutely perfect, because this was $33 million down the drain, no deduction. Substantiation. Absolutely, the cases here are astonishing. This Durden case. So the under 170, I think it's 170 F8 or around there. That's where the requirement of a substantiation of all donations over a certain trivial threshold is required, and there are specifications, things that have to be on the receipt, which include no goods or services were provided in exchange. So this one here, while this is a smaller number, it's not a trivial number. And again, the court went through this whole little theater of, yes, everything was charity, you really got nothing back, everything is fine, but you didn't get a perfect substantiation statement by the deadline, which is when the return plus any extension. I myself have gotten, over the last few years, half a dozen letters from charities, all in cash, of my own cash giving, that lack that statement. And I get on the phone and send it right back. I say, I'm sending this back. This is no good. What are you people doing? Are you sending out mass mailings without the magic words? Would an agent fight you for a $500 deduction or a modest deduction, whether it's cash or property? I don't know, but they certainly have absolutely adequate backing on that in the case law. Here's my favorite. And again, this is $64.5 million charitable contribution, excuse me, denied. And again, in principal part because the acknowledgement lacked the no goods or services language. How somebody could be donating an asset of that value, especially taking that much of a contribution, without, particularly, this case isn't that old, particularly after there's cases going back, and I don't think the Durden in 2012 is the first. Some of these other cases are a little more recent, but still, these are no surprises at this point. The law requires these things, and yet, despite probably having an army of advisors to implement the transaction, the IRS won this, and the deduction was lost. This was a conservation easement transaction, and as I said a little while ago, the IRS is on the warpath against conservation easements in certain circumstances. They didn't have any trouble with the fundamental elements of the conservation easement here. It was just it was mainly no goods or services, a few words missing from the letter, and that was the end of the story. So that brings us right up, I think. I have like a minute. So this was in my 1 minute left. This was a case of a guy who had an unusual collection. I call it paperweights. It wasn't quite paperweights, but it was a very obscure and unusual thing. But the guy was passionate about it, and had amassed this enormous collection of oddball objects. And the question was whether we could find somewhere that would accept a donation of this collection. It was going to be hard to appraise because qualified appraisers have to be experts in the thing being appraised. So you don't get real estate appraisers appraising yachts and stuff like this. We had to search high and low to find somebody who could appraise this kind of curious asset, and then someone that could take it where we could make up a case for related use. We found a sort of a technical museum that took historic technical, handmade objects and things like that. And we got that out, but it was a big donation at the end of the day. But it was a really interesting story. Just about every issue that I've talked about through here, right up into getting the qualified appraisal and making sure the substantiation letter was perfect, start to finish. There's a lot of time, a lot of effort, but the guy got a very secure charitable contribution out of it at the end. I think that's the end of my allotted time.
Well, thank you very much, Michael. And again, that was a great presentation. For anybody that has an issue possibly opening up the link that we sent out earlier to the first presentation, if you want to send myself or Matt McGarland at our office an email, we'll be happy to make sure you get that information. Michael, thank you again for taking the time to present this material for us. I hope it was worthwhile for everybody that listened, and I hope everyone has a great day, and thank you again for your participation.
Thank you, Ken.